Good afternoon, everyone. In today's video, I'd like to explore the volatility that we saw today, which was a little bit different and I think peculiar for some interesting reasons, let's put it that way, and I'll share what I think those are in today's video. Now, the first note to start off with is today we had a scheduled volatility catalyst event, and that was with Powell scheduled to speak at 2 p.m. Eastern, and this was today, May 17th. Now, using this idea that whenever Powell speaks, we've seen the markets have moved, at least in historical times. You can also go back and take a look and review some of the past FOMC meeting minutes, and every time those have been released, what has typically happened? We've seen fairly dramatic volatility in terms of what volatility model we end up using whenever the Powell announcement comes out. It's typically one of our doomsday models, or maybe even something a bit more aggressive or conservative, with the conservative or doomsday conservative models. The short idea there is we're usually on one of these three here, suggesting that the markets tend to move whenever Powell speaks. Today was a little bit different, and I thought that was interesting to call out. Now, inside of the S&P 500 here, to start off, the event was scheduled for 11 a.m. Pacific. This is 2 p.m. Eastern, 11 a.m. Pacific. So this is where that volatility took place. Leading up to that event, we were on our scalper Volatility Box models. That was the one being respected. That's the one we sent out to all of our Volatility Box members in the morning note. The one trade setup that we had was the long entry, where price fell inside of our Volatility Box entry lines. We had the edge signal, and we had a nice bounce from there, hitting T1 and T2. And for those wondering what each of those are, the first target is that cyan line to the outer edge of the clouds, around 10 points. And after you hit T1, stop is moved to break even, so a risk of 0 or a little bit more if you want to protect commission. And the second target is at the gray target line, which in today's case is about 22.5 points away. So first trade, 10 points, then you move your stop to break even. And in today's case, that second target was about 22 S&P points away, which we did hit. So a really nice trade there, and we go all the way to the other side's Volatility Box. We bounce away from there, no setup here that meets our rules, so we don't get a chance to short this, but it is one that respects our model, so call that another point for the scalper models, if you will. So as of right now, the scalper headed into about 9 a.m. Pacific is 2-0 for the day, something that doesn't typically tend to happen on days in which we have a scheduled volatility catalyst event, especially when we've seen the kind of volatility that we've seen over the past few weeks. Now, taking the S&P one step further, the next hour, 9 to 10, one more time we hit the cyan line, one more time we reverse. So now we're at 3-0 for the scalper in terms of how it's been performing in terms of price reacting to those levels. One trade that gave us a setup, a really nice trade. Two trades that have just triggered our volatility box breaches but haven't met our rules. Now we chop around sideways until the actual FOMC event. And I have some footage that I'll try and include as well of price actually reacting when FOMC comes out. I'll put that towards the end, and maybe that will just be visual only with some background music. But what we had today in terms of the actual announcement was we had very similar to the model we're used to seeing with FOMC minutes. We had the initial reaction, we then had a fade of that reaction. What happened last time is we saw that fade, and then I believe we continued in that direction of the trend. This time, we followed somewhat of the model, actually reversing. Now, in terms of the volatility that we saw in this 11 to 12 hour when the FOMC volatility started to kick in, we see here first price went outside of our scalper models before we saw our edge signal confirmation. But we did bounce from there in terms of respecting those models. So you could have argued you hit one more target or a scalper target here before price eventually went out. So we did end up expanding in terms of volatility, but we only expanded to the aggressive volatility box models. Once I load in the aggressive volatility box, that was pretty much it. So the S&P today, in terms of the Powell volatility, the scheduled volatility that typically takes us into the doomsday aggressive, the conservative, or the doomsday conservative, only really took us into the aggressive, and that was really off of the backs of the Dow. The Dow was the market today that was a little bit more aggressive. The NASDAQ, if you compare in that same period, while it did go outside of the clouds here, the NASDAQ earlier on was the one market in that 7 to 8 a.m. Pacific hour that actually bounced very similar to the S&P 500. If you look at the Dow here, that same period, you'll see the Dow actually went outside of our clouds here. So the Dow was the more volatile one, headed into the Powell statement volatility, headed into really the rest of the day as well. So Dow here more volatile, S&P the middle ground, and the Nasdaq was the one that was less volatile out of the three major markets today. Now, one other thing I thought was interesting is during that volatility in that 11 to 12 hour, the one ETF that sold off enough to actually breach the aggressive Volatility Box's lines was XLE. That's the energy ETF, and this is off of the new hourly volatility models, where the energy ETF sold off enough to actually hit the cyan lines and then bounce up away from there. This was different from, say, even XLK. XLK here fell short of those cyan lines. XLY fell short of the cyan lines. XLC fell short of the cyan lines. XLF only hit the cyan lines on the top side, and then we had that reaction really into the close, right? So all around the board here, XLE was the one market that sort of traced in terms of the moves that we had inside of the S&P and the Dow with the volatility, bounced up from there. XLF was on the reverse side where we had the short side set up once we actually had that bounce into the close, but not really that much time for follow through. Alright, so hopefully from today's video, you understand what I mean by today's volatility was a little bit different. We really stayed in these two regions right here, between the scalper and the aggressive on the major ETFs, and inside of, say, even our sector ETFs here, we fell really only to the aggressive Volatility Box model. So across the board, volatility was sucked out today on a day where I think, at least I was expecting a little bit more volatility to be present. So an interesting data point that we can add to our series of Fed-related tracking points, if you will. They're usually FOMC minutes, but today was a little bit different, but I thought another interesting point that we could add. Let me now play you the real-time price reaction so you can see how price reacted to the models and how everything actually took place real time.